Welcome to the Deep Dive, your shortcut to being genuinely well-informed. Today, we're taking a look into the recent Q1 FY26 earnings for Tips Music Limited. They're a pretty big player in the Indian music scene. We've sifted through, well, quite a bit. The earnings call transcript, their financials unaudited, mind you, the investor presentation, press releases, the works.
Yeah, quite a stack. And our goal here is really to cut through the noise, pull out the key insights for you, and basically understand what's actually going on with Tips Music.
Yep.
And that tells us a lot about the wider music industry too, right? Think of this as your backstage pass. It's where culture meets commerce.
Okay, backstage pass, I like it. So, first impressions, are things looking good? Are they, hitting the right notes?
Well, look, there are definitely challenges in the industry, no doubt, but Tips, they're showing some real resilience. We're seeing double-digit growth on the top line, and importantly, they've declared an interim dividend.
Ah, the dividend.
Yeah.
Always a good sign for shareholders, usually signals confidence.
Exactly. It tells us they feel pretty good about how things are going.
All right, let's get into the numbers then. What are the headline figures? What really jumped out?
Okay, so revenue for Q1 FY26, they pulled in 88.1 crores.
88.1 crore. Now, how does that compare?
That's a solid 19% jump compared to the same quarter last year, Q1 FY25. So yeah, strong top-line growth. Then you look at the profit after tax, the PT, that came in at 45.7 crores.
Okay, 45.7. And growth-wise?
That's 5% year-over-year growth from Q1 FY25. So growth, but slower than the revenue growth.
Right. And the dividend you mentioned, how much are we talking?
So the board declared 4 per share. That's the first interim dividend for fiscal 26. It should be paid out by August 26, 2025. Adds up to a total payout of 51.13 crore.
51 crore. That's pretty substantial. Definitely signals confidence, like you said.
Yeah.
But digging a bit deeper, I saw something interesting, maybe less positive. The content costs, they seemed really high.
Ah, yes, you're spot on. Content costs went up, wait for it, 85% year over year.
85%,
Yeah.
wow.
Yeah. Huge jump. It went up to 23.5 crores from just 12.7 crores in Q1 last year. The reason? Mostly expensive new releases they pushed out during the quarter.
Okay, an 85% jump.
Mm-hmm.
That must have hit their margins pretty hard.
Oh, absolutely. It really squeezed the operating margins. They dropped down to 64% from, 73.6% in Q1 FY25. So for you listening, that basically means for every rupee of revenue, less was left as operating profit after paying for things like that new content.
And that would naturally flow through to the profit after tax growth, too, explaining why it was only 5%.
Precisely. It all connects.
So if we step back for a second,
Yeah.
what's the main story these numbers tell? What's the strategic takeaway?
Well, I think what's fascinating is that even with these rising costs, the revenue is still strong. Shows resilience, right? They're clearly investing heavily in new content. That's their pipeline, their future, but they're still finding room to give back to shareholders with that dividend.
So a balancing act, investing for tomorrow while keeping today's investors happy.
Pretty much. It suggests they're trying to manage both long-term vision and current financial health.
Now, you mentioned revenue resilience. It's pretty clear digital is the engine here.
Yeah.
How much comes from online? And what are the trends, say, on YouTube?
Digital is absolutely dominant. Get this. A full 72% of their revenue flows through digital platforms.
70%, okay.
Yeah. Now, YouTube, it's a bit of a mixed bag this quarter. They noted slower growth. Put it down to a couple of things. Lower ad spends generally, and also some key changes YouTube made to its policies.
Policy changes, like what?
Specifically, YouTube is restricting how user-generated content, UGC, can be used and monetized.
Okay, so users uploading videos with tips music in the background. Less of that being monetized by the user.
Exactly. Or, covers and remixes and things.
On the surface, that sounds like it should be good for tips.
Yeah.
Less unauthorized monetization. But doesn't it risk hurting discovery as fewer people use their tracks?
That's the million-dollar question, isn't it? It might seem like a drag on organic reach short term, but the company, and frankly much of the industry, sees this as positive in the long run. It helps clamp down on, third-party piracy. It shifts the power and the monetization back towards the actual rights holders, like Tips.
So it's part of a bigger shift. Tightening control over content.
Yeah, you could say that. It's pushing the ecosystem toward being more structured, more beneficial for the owners. And on the plus side, for YouTube, they did mention healthy growth in paid subscribers.
Interesting. But I also read something about total YouTube views being down, especially related to shorts. How does that work if shorts views are huge but maybe not monetized the same way?
Right. So total YouTube views were a bit flat sequentially and actually down 9% compared to Q1 last year. That was mainly due to fluctuations in YouTube Shorts views. Now, the key thing with Shorts monetization, currently at least, is that it's based on a fixed deal.
A fixed deal, not per view.
Correct. Tips gets a kind of pre-agreed amount, not payment for every single short view. It's different from the traditional long-form video monetization.
Okay, so the ups and downs in shorts views don't directly swing their revenue right now.
Exactly. But strategically, shorts are still seen as important. They act as promotion, driving people to discover the full songs, the long-form content, which is monetized per view or stream. So it helps overall revenue indirectly. Of course, Tips, like everyone, hopes for a proper per-view model for shorts eventually. That would be a big boost.
Got it. So shorts are like trailers driving traffic to the main event. What about other platforms? Meta, Spotify.
Yeah, on Meta, so Instagram and Facebook, they reported consistent growth in content consumption, seems steady there, and Spotify. Also positive news, healthy growth in premium paid subscribers.
It really feels like there's a larger trend here, beyond just one platform, a shift towards paying.
Absolutely, that's the big picture. The whole industry is moving, as they put it, slowly and steadily into a paid ecosystem model. We're seeing more OTT music platforms putting up paywalls. Ghana, Hungama, they've moved entirely to paid. Amazon launched a full paid service too.
And that's seen as good for Tips and the industry overall.
Definitely. It might mean fewer total free listeners in the short term, but potentially much higher, more sustainable revenue per user over time. It's a potential game changer if it takes hold properly.
Okay, shifting gears slightly. Operationally, I heard about something called Pulse. What's that about?
Pulse. Yeah, that's their new in-house content management system. Basically, it automates getting their music and metadata out to all the different platforms, TikTok, Spotify, Apple Music, all the DSPs. They use their own DDX feeds. That's just a standard format for this stuff, which gives them more direct control.
So streamlining things.
Yeah.
Making it more efficient.
Exactly. And importantly, they built it with their existing teams. So no big hike in employee costs expected from this, just a smart internal efficiency move.
Makes sense. Let's talk content then. That 85% cost increase, what were they releasing? How many new songs in Q1?
They put out 92 new songs in Q1 FY26. It was a mix, 48 film tracks and 44 non-film ones. One standout they mentioned was a Punjabi track, Main Nachdi, got over 75 million views, charted for 12 weeks on YouTube's Top 100, so definitely some new stuff hitting.
Okay, 92 new songs, but I still get the sense their older catalog is the real powerhouse. What are those numbers like?
Oh, the catalog is just incredible. It's evergreen. Take Chinari Chinari, the Salman Khan classic.
Yeah.
It earned 2 billion views on Meta platforms.
2 billion just on Meta.
2 billion. It's staggering.
Yeah.
And it's not alone. Hanathi did 500 million views on Meta. Bil Humar hit 700 million. Even slightly newer film songs like Malak and Sarbalaji are doing massive numbers on YouTube, over 100 million and 50 million views, respectively. These aren't new releases.
Wow. 2 billion views for Chinari Chinari. That says so much about longevity, doesn't it?
Yeah.
How do they view that older music?
They have immense faith in it. They also hit 125.8 million YouTube subscribers, which is huge, showing a 20% compound growth over the last 2 years. They actually have a great term for their 90s stuff, new retro.
New retro, I like that.
Yeah, it captures it perfectly, right? It's not just nostalgia. These tracks are finding new audiences, constantly being rediscovered, maybe on Reels or Shorts. They believe this new retro stuff will perform well for, another 20, 25 years at least.
That's quite a belief.
Yeah.
So connecting that back to the content costs, how does this new retro strength influence their spending on new music?
Well, even with that huge back catalog, they know they need new hits too. Their focus, they say, is on quality content, not just volume. The target is to invest around 25-28% of their revenue back into new content.
25 to 28%.
Right. And they did say they're willing to nudge that up slightly if a really high-quality opportunity comes along that looks like a sure bet for the future. So they're disciplined but flexible.
And they have that unusual accounting policy for these costs, don't they? Writing it all off immediately.
That's right. It's quite unique. They expense the entire cost of producing a song or acquiring rights in the very same quarter it's released.
So they take the full financial hit up front.
Exactly. The benefit is, after that quarter, the content essentially sits on their books, generating revenue with no associated costs dragging down future profits. It cleans the slate quickly.
No long amortization tail weighing things down. What kind of payback are they looking for internally on that investment?
Internally, they target a payback period of about 3 years. When talking to analysts, they tend to be a bit more conservative and say maybe 4 or 5 years.
Okay, so zooming out again to the
Yeah.
wider industry, what are the biggest challenges, the headwinds they're facing right now?
Well, it comes back to what we discussed earlier, that shift in the OTT space. The
Hmm.
fact that platforms like RO, Ghana, Hungama are either closing or moving fully behind paywalls. That creates transition pains.
Right. Even if it's good long term, the short-term shift can be bumpy. Fewer free users, maybe slower overall adoption initially.
Exactly. It creates uncertainty as listeners get used to the idea of paying for music streams they might have gotten for free before.
So, given all that uncertainty, how are they feeling about their revenue forecast for the full year, FY26? Still aiming high.
They're being a bit more cautious now. Initially, they talked about aspiring to 30% revenue growth for the year.
30%, okay.
Now, they're saying they're confident they can achieve 20% growth. They're still hoping and trying for the 30%, but 20% is what they seem comfortable committing to.
And that caution is directly linked to how fast this paid ecosystem develops.
Precisely. It's the big unknown. How quickly will paid subscriptions make up for and hopefully exceed the value lost from the free ad-supported models? It affects the whole industry.
Makes sense. And what about their Warner Bros. Partnership? Is that becoming more significant?
Yeah, seems so. They expect Warner Bros. To contribute about 25–30% of their total revenue this fiscal year,
25 to 30. Up from what?
up from around 20–25% last year. So yeah, that partnership is growing in importance for them.
Okay. And how do they decide, big picture, how to use their cash? Content versus dividends, for example.
They have a pretty clear, almost formulaic capital allocation policy, which investors probably appreciate. Step 1. Allocate that 25–28% of current year revenue to new content investment. Step 2. Take the profit after tax, the PAT, from the previous full fiscal year and distribute that as dividends during the current fiscal year.
Ah, okay. So this year's dividends are based on last year's total profit.
Exactly. So for FY26, the dividends will be based on the total PAT they earned in FY25, which was 166.6 crores. It's a systematic way to return cash while funding growth.
Very clear. One last area protecting all this valuable music, their IP. How do they manage that in the digital age, with piracy still a thing?
It's a constant battle, of course. Their main tool is YouTube's Content ID system.
Right, the automatic scanning.
Yeah, it automatically scans uploads and flags when their music is used, allowing them to claim monetization or block the content. It's pretty effective for direct copies.
Yeah.
The challenge comes with more sophisticated piracy stuff that's slightly tweaked, remixed, or covered in a way that tries to evade Content ID. AI tools are making this easier for pirates too.
So the cat and mouse game continues.
Pretty much. YouTube is trying to improve its systems to catch this stuff, especially restricting the UGC monetization we talked about. But yeah, it's an ongoing effort for rights holders like Tips.
So if we wrap this all up,
Mm-hmm.
what's the final take? Tips Music seems to be navigating some choppy waters, but still sailing pretty steadily.
Yeah, that feels right. Strong financials overall, showing resilience. They're clearly adapting to this big digital shift towards paid models.
And they're leveraging that amazing new retro catalog while still investing in new hits. Plus, making smart moves operationally with things like Pulse. Exactly. And understanding these pieces, the numbers, the strategy, the industry context, gives you, the listener, a much richer picture. It's more than just earnings. It's about the future of music consumption.
Which brings us to a final thought, perhaps. The music industry is changing so fast, isn't it? You've got AI creating music, the relentless shift to subscriptions, short-form video totally changing discovery. So the big question is, how do companies like Tips keep balancing the incredible long-lasting value of those older hits, their retro gold, with the constant need to find and monetize new music? Especially when global platforms like YouTube or Spotify keep changing the rules of the game.
What does that mean for how music gets made, how it gets discovered, and ultimately how you might end up experiencing music very differently in the next few years? Something to think about.